Our next topic is on the basics of accounting. What is it? Who uses it? And why do we have it? The actual definition of accounting is it's an information and measurement system that identifies, records, and communicates information about an organization's business activities to interested users. Now let's break down this definition. First, it's an information and measurement system. We are merely gathering information that will explain the financial status of a business. It's a system that identifies, records, and communicates information. We're going to identify a business transaction, record it in the company books, then communicate it with interested parties. You're going to learn these three steps in this course. Most of the time, communication comes in the form of a financial statement. I can pull up the financial statement of any publicly traded corporation, and since I know how to read these statements, I can see how profitable these companies are, what their debt situation is like, and how they operate their business. The next part is who are these interested users? Interested users can be internal or external to the business. Internal users would be those that are directly involved in managing and operating an organization. An example would be management. External users would be those that are not directly involved in running the organization. An example would be those who are not managers, such as an investor. We will look at more examples of interested users next. We're going to work on the first classwork question. You should have classwork 1 downloaded or printed. Fill this in as we go over it. Ideally, you should pause this video and work on it yourself. Then unpause the video to see which ones you got correct or incorrect. It doesn't take a rocket scientist to know that you learn better when you do it yourself instead of just listening to someone else explain it. Pause it now to see if you understand this topic. Okay, for part A, it's customers. Do you think that customers would be external or internal to the company? Well, a customer is not an employee of the company, therefore it would be external. What about a supplier? These could be other businesses that we get our supplies from, our materials from. Are they managers in our business? No, even though we buy stuff from them, they are still external. I buy stuff from Amazon all the time. That does not mean that they work for me. For part C, we have brokers. In this case, we're thinking about like a stockbroker. I can hire someone from, let's say, Merrill Lynch. I will give them my money and they can invest for me. Yes, they are hired to do a job for me, but they're not employees of me. I pay them to do this job, and that's it. That stockbroker who does the investing for me, they work for Merrill Lynch. They are employees of Merrill Lynch. They're not employees of me, but they are providing me with a service. In this case, it would also be external. What about part D, the business press? Let's say the New York Times. They come and do an article on you. Are they an employee of you? No, they're not part of our management. They are also an external user. Part E, managers. This is one of the few ones that would be internal because they are employees of our company and they are managers. F, we have the district attorney. They are not employees of our business. They would work for the district attorney's office. They are also external. What about lenders? You take out a loan from a bank. They are also external. They do not work for our company. They're not part of our management. Controllers. A controller is an individual who has responsibility for all accounting related activities, including the high level accounting, managerial accounting, and finance accounting within a company. They would also be internal. This is the only other internal one on here. Controllers are in a management position of a company. And lastly, part I, we have the FBI and IRS. They are also external. They don't work for us. Our next slide talks about ethics because this is one of the most important concepts in accounting. We have many of our rules and regulations that are a result of unethical accounting practices in the past. After you take the CPA exam, there's a second exam in order to get your license that is all about ethics in accounting. That's how important this is. So, what are ethics? It is the difference between right and wrong, honest and dishonest, fair and unfair. In accounting, when we are deciding if something is ethical or not, we ask ourselves, what would a reasonable person do in the same situation? Now, in accounting, there's very little gray area. Most actions are either one or the other. For example, don't steal money, don't share confidential client information, don't make false transactions. In the past, there were many scandals and fraudulent accounting happening. Investors started to lose confidence in the American stock market, and we need investors in order for our corporations to grow. One of the biggest and most known scandals is from Enron. If you haven't heard of Enron before this, don't worry, this is just the very beginning. You will hear about this company in many future business classes that you will have. I have a short video that describes what happened.
Enron used to be the seventh largest corporation in the United States, at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
So, what did they do after investors lost confidence in the financial market? Congress passed the Sarbanes-Oxley Act of 2002, also known as SOX. SOX not only affects accountants, but business managers as well. This won't be the last time you hear of SOX. SOX has helped promote independence, meaning those with a bias or vested interest cannot perform audits, more transparency in their financial reporting, more management involvement, which includes CEOs signing off on financial reports. Currently, around 25% of all CEOs have an accounting background. It has also provided more severe penalties for those that do perform financial abuse. There are some very interesting movies involving financial crimes that I recommend watching, such as Too Big to Fail, The Smartest Guys in the Room, and The Big Short. Congress has also enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act, which promotes accountability and puts an end to bailouts and this too big to fail notion. Lastly, we're going to discuss the fraud triangle. This is something we're going to discuss more in a later chapter. The fraud triangle consists of 3 points that, when present, increase the likelihood of fraud occurring. It does not mean that fraud will 100% occur or that these 3 points are definitely needed for fraud to occur, but the chances do increase when one or more of these factors are present. The 3 points are opportunity, pressure, and rationalization. I'm going to play another video that does an excellent job explaining what these 3 factors mean.
If you ask people whether they think stealing is wrong, most of them would answer yes. And yet, in 2013, organizations all over the world lost an estimated total of $3.7 trillion to fraud, which includes crimes like embezzlement, pyramid schemes, and false insurance claims. This wasn't just the work of a few bad apples. The truth is that many people are susceptible not only to the temptation to commit fraud, but to convincing themselves that they've done nothing wrong. So, why does fraud happen? While individual motivations may differ from case to case, the fraud triangle, a model developed by criminologist Donald Cressy, shows three conditions that make fraud likely: pressure, opportunity, and rationalization. Pressure is often what motivates someone to engage in fraud to begin with. It could be a personal debt, an addiction, an earnings quota, a sudden job loss, or an illness in the family. As for opportunity, many people in both public and private sectors have access to tools that enable them to commit and conceal fraud. Corporate credit cards, internal company data, or control over the budget. The combination of pressure and being exposed to such opportunities on a daily basis can create a strong temptation. But even with these two elements, most fraud still requires rationalization. Many fraudsters are first-time offenders, so in order to commit an act most would regard as wrong, they need to justify it to themselves. Some feel entitled to the money because they are underpaid and overworked, and others believe their fraud is victimless, perhaps even planning to return the money once their crisis is resolved. Some of the most common types of fraud don't even register as such to the perpetrator. Examples include employees fudging timesheets or expense reports, taxpayers failing to report cash earnings, or service providers overbilling insurance companies. Though these may seem small and can sometimes only involve hundreds of dollars, they all contribute to the big picture. And then there's fraud on a massive scale. In 2003, Italian dairy food giant Parmalat went bankrupt after it was found to have fabricated a $4 billion bank account and falsified financial statements to hide the fact that its subsidiaries had been losing money. Because it was family controlled, corporate governance and regulator supervision were difficult, and the company likely hoped that the losses could be recouped before anyone found out. And it's not just corporate greed. Governments and nonprofits are also susceptible to fraud. During her time as city comptroller for Dixon, Illinois, Rita Crundwell embezzled over $53 million. Rita was one of the country's leading quarter horse breeders and winner of 52 world championships, but the cost of maintaining the herd ran to $200,000 per month. Because her position gave her complete control over city finances, she was easily able to divert money to an account she used for private expenses, and the scheme went unnoticed for 20 years. It is believed that Cromwell felt entitled to a lavish lifestyle based on her position and the notoriety her winnings brought to the city. It's tempting to think of fraud as a victimless crime because corporations and civic institutions aren't people. But fraud harms real people in virtually every case. The employees of Parmalat who lost their jobs, the citizens of Dixon whose taxes subsidized horse breeding, the customers of companies which raised their prices to offset losses. Sometimes the effects are obvious and devastating, like when Bernie Madoff caused thousands of people to lose their life savings. But often they're subtle and not easy to untangle, yet someone, somewhere, is left holding the bill.
We are going to practice looking at some scenarios that involve the fraud triangle next. This is question number 2 on your classwork. There are 6 scenarios, and you need to identify which of the 3 factors of the fraud triangle these apply to: opportunity, pressure, or rationalization. Once again, you should pause this video now and try these on your own first. Scenario A: the business has no cameras or security devices at its warehouse. This would be an example of opportunity. Without any cameras or security devices, there might be an opportunity for an employee to commit fraud. B: managers are expected to grow the business or be fired. This is a lot of pressure. Imagine if these managers are not growing the business and they lose their job. This added pressure can cause them to act unethically. Pressure. C: A worker sees other employees regularly take inventory for personal use. This is a bit of a tough one. You're seeing other people do it, therefore, you rationalize that it's okay for you to do it as well. This would be R, rationalization. D, no one matches the cash in the register to receipts when the shift ends. Well, if no one's matching cash in the register receipts to check to see if it balances out, if it was off, no one would know. This is an opportunity for someone to commit fraud. E, cash is placed into an unlocked drawer overnight. Once again, this provides an opportunity for someone to commit fraud since it's unlocked. A better control would be for there to be a safe with a combination. Lastly, F, an employee's house is in foreclosure and they cannot pay their debts. This one would also be pressure, but unlike part B, where there's pressure at the job, and part F, there's pressure at home. This is why some companies will check your credit background if you're working in a financial institution. If you're going to be around money all day, then it's better to make sure that you do not have money problems of your own because there's pressure and it adds to the temptation. This next slide discusses the accountant's rule book. This is called GAAP, GAAP. It stands for Generally Accepted Accounting Principles. The SEC is tasked with overseeing the financial sector. They made a board called the FASB, which stands for Financial Accounting Standards Board. This is the body of people who sets our rules, which are GAAP. Think of it like this. The FASB is a group of people who make the rules. GAAP is what we call the rules. Does every bookkeeper, business owner, and accountant have to follow these GAAP rules? Surprisingly, the answer is no. GAAP is only required for public companies in the United States. A public company is a company listed on the stock exchange. This means if you open your own little business selling trinkets online, you do not have to follow GAAP rules. However, in this course, you will learn the GAAP rules since it is required for all public companies. I have one more video to show you, which explains GAAP better than I could. I know there were a lot of videos, but this is the last one for this chapter.
Imagine a world of streets without signs, or scales without numbers, or ballets without choreography. The result would be confusion, chaos, or worse. Rules help the world run more smoothly. The same is true for financial information. If companies, governments, or nonprofits just made up numbers to represent their revenues, profits, or spending, the result would be economic chaos. Investors wouldn't know where to invest. Citizens wouldn't know how their city, town, or state is using tax dollars. Donors couldn't judge the financial health of a charity. And employees wouldn't know if their retirement funds were secure. Fortunately, there are rules and guidelines that determine how to present financial information. In the US, these rules are known as GAAP, or Generally Accepted Accounting Principles. It's the playbook that companies, governments, nonprofits, and employee benefit plans must follow when presenting their financial information. GAAP supports the economy in many ways. First, GAAP provides concise, relevant financial data to global markets. That's because high-quality financial reports make it much easier to analyze the numbers and make informed decisions. Second, clear financial rules give lenders and investors greater confidence in the accuracy of financial reports, making it easier, faster, and less expensive to borrow money or secure financing. Third, GAAP makes it easy to compare numbers, both across time and across organizations. Investors and others can compare a company's performance this year with last year, or against other companies. And voters can understand if their state or town's finances are getting better or worse. GAAP financial reports make companies, governments, and other organizations more accountable for their financial performance. That spurs better management decisions and helps make the economy more efficient for everyone. Maintaining and improving GAAP has been the mission of the Financial Accounting Standards Board since 1973 and the Governmental Accounting Standards Board since 1984. Supported by the Financial Accounting Foundation, these standard-setting boards listen to investors and other stakeholders to understand how to make GAAP even stronger than it is today. Developed over decades, GAAP has stood the test of time, driving greater clarity in the world's largest capital market.
GAAP applies to what we do here in the United States. Currently, there is a board called the IASB, International Accounting Standards Board, which is in charge of overseeing international accounting rules. The international accounting rules are called IFRS, which stands for International Financial Reporting Standards. The IASB is equivalent to our FASB, and IFRS rules are equivalent to our GAAP rules. This is all in an effort to have one method of accounting for every country to follow. We would easily be able to compare a company like Ford, which is in the US, to Honda, which is a Japanese company, if their financials are presented in the same manner. Do we follow the international standards? No, we don't. We follow US GAAP. Currently, there are more than 100 countries that use the same system. Unfortunately, we are not one of them. If accounting becomes your major, you will most likely need to take an international accounting course or global accounting. It will go into detail the differences between our rules and the international ones. IFRS standards are also on the CPA exam. We are currently trying to converge. This means that we are trying to modify the GAAP rules to be more like the international rules, while the international rules are trying to modify their rules to become more like us, GAAP. We are hoping to meet somewhere in the middle, but that has not happened yet. In this course, you do not have to learn any of the international standards, but just to know that it's there and what we follow. Our next 3 slides are all related. First, we're going to discuss accounting principles, then assumptions, then constraints. First are the basic accounting principles. First, we have the measurement or cost principle. This means that accounting information is based on actual cost, not what something currently costs in the marketplace. For instance, if we bought a piece of equipment, we're going to put it on our books for what it cost us. We're not getting it reappraised every year to see what it's worth because that would be too objective. The only time that we can get something appraised basically or change the value to what it's currently going for is when we're dealing with stock, and we don't get to that until accounting 2. So that's something you do not have to worry about right now. Next, we have the revenue recognition principle. This recognizes revenue when it is earned, not when received in cash necessarily. For instance, this is how we're going to do all of our journal entries. If we make a sale and someone pays us later, we're still going to recognize the sale when we performed the service or gave them the product. If we got paid early in advance for something, we're not going to recognize it as revenue until we have completed our part, which is providing the service. So revenue recognition means that we're going to record something as revenue when we have completed the service or provided the product to the customer, not necessarily when cash is paid. Next, we have the expense recognition or matching principle. A company must record its expenses incurred to generate the revenue reported in the same time period. This means if I look at a monthly statement that shows all the revenue I made that month, I'm also going to see all the expenses related to me earning that revenue. For example, all the salaries of all my employees who had to work for me. I needed to pay them in order for them to help generate these sales. Lastly, we have the full disclosure principle. A company is required to report the details behind their financial statements that would impact users' decisions. You cannot withhold something on your financials if it's important. If it would make the difference between having someone invest in you or not, then it's important enough for it to be disclosed on your financial statements. This next slide is on assumptions. Everything on here are things that we're assuming. First, we have the going concern assumption. This is the assumption that the business will continue operating instead of being closed or sold. If an auditor didn't think that a company would be in business this time next year, they would have to disclose it on their annual financial report. Unless disclosed, we're going to assume that this is a viable business. Next, we have the business entity assumption. A business is accounted for separately from other business entities, including its owner. If I'm looking at the financial statements for company A, it's only on company A, not B, C, and D all added together. Next, we have the time period assumption. This presumes that the life of a company can be divided into time periods, such as months and years. Lastly, we have the monetary unit assumption, where transactions and events are expressed in monetary or money units. The final slide of this topic is on constraints. These are things that hold companies back from having perfect financial reporting. First, we have the cost benefit constraint. Only information with benefits of disclosure greater than their cost need to be disclosed. I always say that in order to have financial statements be 100% perfect, you need to check 100% of the business, which is usually impossible. Imagine if we had to check every single piece of inventory Amazon had to make sure that it was all there and it wasn't damaged or broken. They would have to close the business down for months probably and hire thousands of people to check every single item. The cost isn't worth it. If a few slip through the crack, that's okay. It's worth it compared to how much they would spend to have every piece of item checked. The other constraint is materiality. Only information that would influence the decisions of a reasonable person need to be disclosed. If you have a multi-billion dollar company and one account is off a few $1,000s, that is not material enough. That would be considered immaterial. It's not worth investigating compared to how much the business is as a whole. This is something you learn a lot about in an auditing course. Please check the links below for help if you need it. There are videos I have posted that relate to this, including YouTube videos and videos from the textbook publisher.